Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Tuesday, October 7, 2008. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's 4:30 p.m. in London. In Mexico City, it's 9:30 a.m. If you need to reach us during the broadcast, you can call in from the U.S. toll-free at 1-866-67-CATEX. Overseas, our AOL Instant Mail address is CATEX-TV. On this day in history, in 1985, 23 years ago, Palestinian gunmen hijacked the cruise ship Achille Lauro in Alexandria, Egypt, with 400 people aboard. Eventually, the day later, actually, they threw American tourist Leon Klinghoffer overboard. The man was in a wheelchair. Today's birthdays, South African Archbishop Desmond Tutu is 77 years old today. Simon Cowell, for those people who watch it, is 49. We have a couple of breaking stories. The first is an international story. About an hour or so ago, the Iranian news service was reporting that an American military aircraft had strayed into its airspace and was brought down without incident in Iran. And after questioning, the plane was allowed to leave. The Iranians were reporting that it was a Falcon aircraft. The White House just a few minutes ago said that it's looking into Iranian reports of an aircraft carrying U.S. troops having been forced down, but it had no reason to believe that they were correct. If we have any more news on that toward the end of the broadcast, we'll come back and tell you. Some reinsurance news. Amlin, one of the largest syndicates in Lloyd's, Amlin Insurance, said that one of its wholly owned subsidiaries has acquired French underwriting agency Financière Europe Assurance, the holding company of Anglo-French underwriters. Also this morning on CNBC, the American Business Network, Willis Chairman and CEO Joe Plumeri, talking about AIG, said if someone like AIG has issues, it's going to scare a lot of people because it has something like 5 or 10% of the capacity in the insurance industry. By the same token, I'm not alarmed because I think AIG's business from an insurance point of view are great and they're walled off. The problem with AIG were somewhere else. They're doing fine. My insurance is with AIG myself. Later on, we'll find that Mr. Plumeri was exactly correct, as the New York insurance superintendent will say. And now to our main news. Stock market is down about 70 points now as we start. Yesterday was obviously a tumultuous day, and the Federal Reserve has once again taken action. They've now announced that they're going to buy commercial paper in an effort to restart the credit market that's virtually shut down. This is yet another unprecedented move to combat the credit crunch. The Fed has set up a special purpose vehicle to purchase 3-month unsecured and asset-backed commercial paper. The Fed said that the Bush administration believed the move was necessary and will make a special deposit with the central bank to support the facility. According to the Federal Reserve, quote, by eliminating much of the risk that eligible issuers will not be able to repay investors, this facility should encourage investors to once again engage in term lending in the commercial paper market. The Fed did not give an estimate of how much commercial paper it would purchase. The market for this critical financing, which relies on investors rather than banks, has virtually dried up. The notion under the plan is for the government to provide a backstop that would give companies a new place to get cash. The action also makes the Federal Reserve a source for credit for non-financial businesses, in addition to commercial banks and investment firms, which it's already supporting. At this hour in Washington, D.C., a hearing is going on concerning AIG. The government's rescue of American International Group last month is getting a critical eye from lawmakers examining the chain of events that forced the $700 billion bailout of the financial industry. 3 former AIG CEOs, including its largest individual shareholder, Maurice Greenberg, were scheduled to testify this morning before the House Oversight and Government Reform Committee. At the last moment, though, Mr. Greenberg canceled his appearance. A spokesman said he was ill. New York Insurance Superintendent Eric Dinello and former CEO Robert Willemstad did testify. I'm going to switch to some other notes here. The committee chairman, Henry Waxman, a Democrat from California, opened the hearing by describing a week-long retreat that AIG held for its executives at the luxury St. Regis Resort in Monarch Beach, California, the week after the government put up the $85 billion bailout. Mr. Waxman said that the retreat ran up a tab of $440,000. Mr. Waxman held up a photograph of the resort, and he went on to enumerate the expenses, saying that executives spent $200,000 for rooms, $150,000 for meals, and $23,000 for the spa. He said, quote, less than a week after the taxpayers of the United States rescued AIG, its executives could be found wining and dining at one of the most exclusive resorts in the nation. He then posed the question to Mr. Willemstad why this happened. We don't have Mr. Willemstad's response to this yet, but we'll get to it. Also at the same hearing, New York Insurance Superintendent Eric Dinello said that AIG's troubles came when the insurer got, quote, well away from its core competency of insurance. Dinello said that AIG got too far into the credit default swap market, or CDS. The CDS, he went on to describe, is a complex financial instrument in the bond market in which a bondholder hedges his or her bet against the bond failing by asking a third party to insure it. Dinello said that that's a legitimate and easy to regulate process. The problem is that the easy part accounts for only about 10% of the CDS market. The other 90%, the superintendent said, is what's known as a naked swap, which is similar to a naked shorting of a stock. It's entirely unregulated, and the market size of that could approach some $60 trillion. And that's what AIG was involved in. Yesterday on Capitol Hill in front of the same hearing, Richard Fuld, Lehman Brothers CEO, said that he was upset because the bailout that was extended to AIG was not extended to his company. Mr. Waxman also noted then that Mr. Fuld had received over $500 million in salary and bonuses from Lehman Brothers in the last 4 years. Mr. Fuld was not quite sure that was the amount, but did not deny that in fact it was a substantial sum. Also AIG related, its accountant has made a settlement with the state of Ohio. PricewaterhouseCoopers, which is AIG's auditor, when its price fixing and accounting scandals erupted, has agreed to pay about $98 million to settle claims by 3 state of Ohio pension funds that had invested in AIG. The Office of Ohio Attorney General Nancy Rogers said that the firm's agreement to settle investors' claims in securities litigation against the insurer will be one of the 10 highest settlements ever to be paid by an accounting firm to settle a securities fraud class action. PwC said in a statement, quote, that it decided to settle the case at this stage to avoid the enormous litigation costs that would be incurred if the case continued, while at the same time eliminating any potential exposure. PwC went on to say, quote, that the settlement does not contain an admission of wrongdoing by the firm, and we continue to believe that our work was in accordance with professional standards. PricewaterhouseCoopers continues to serve as AIG's independent auditor. Some news coming out of Germany. Munich Re has been encouraged in its view that the financial market crisis will drive up earnings at reinsurance companies. This was according to a statement by Torsten Jaworek, who was a board member at Munich Re, who is frequently used by the company to advance theories, statements, if you will, that management does not necessarily want to put a face to. However, there's no doubt that Jaworek speaks for the company. According to Jaworek, the latest actions in the financial markets are boosting demand for reinsurance cover. It makes Munich Re even more confident of success that it expects to achieve in pushing through higher prices for the risk it offers to insurers. Jaworek said, quote, for us, the next market is the hard market period. We could drive the market into higher profitability. He said that Munich Re was seeing increased demand for quality reinsurance, cat and long-tail business, and wherever possible was pushing for double-digit price increases in its negotiations with insurers. Munich Re's upbeat prediction for a return to higher prices after years of price declines raised eyebrows among brokers and even among